Good afternoon, everyone. Welcome to our April 2023 monthly conference call, and we thank you for joining us today. This is Jeff Hibbeler along with Randy Farina. Before we get started, I'd like to remind everyone to please send in any questions or comments to info@essentialwealth.com. We will address these toward the end of today's call. So at our last call in early March, little did we know that the weekend after, two U.S. regional banks would be taken into receivership by the FDIC. Silicon Valley Bank was the 16th largest bank at the time, and the second largest bank failure, trailing only Washington Mutual in 2008. Signature Bank was also a pretty decent sized regional sized bank at over $100 billion in assets. Then the next weekend, UBS would be forced to acquire Credit Suisse by Swiss regulators. Credit Suisse isn't what it was before the financial crisis, and its troubles had been well publicized for many years. But still, it was unsettling nonetheless. Markets have had differing reactions to these events over the last month, with equities broadly higher, but bond yields significantly lower. And more on this in a bit. Anytime a larger bank fails, it raises concerns about stability more broadly. Admitted, we are still in early days, but at this point, focusing on the US, I think these are isolated cases rather than a systemic problem. Concentrated deposits, liability and asset mismatches, and some crypto specialization, and particularly at Signature Bank, lent to these problems. And no doubt other banks have securities and loans at losses on their balance sheets. But based on our analysis and assessments, that smaller as a percentage of those banks' balance sheets, and they have much more diversified and broader deposit bases. And in this case, Silicon Valley Bank and Signature Bank were really extreme outliers with their average deposit sizes and the concentrations that they had in their customer base. The other thing is that the bank term funding program, the new facility that the Fed instituted, that's really going to help with liquidity. And also they loosened a bit the standards at the discount window for bank liquidity. So overall, our take is that the banking system, and particularly importantly for markets and the economy with the money center banks, they're well capitalized, they have ample liquidity, and they also have diversified business models. Randy, with stress in a sector can come opportunity. And I wanted to check in with you to see how you see valuations currently in the banking sector.
Sure. Good afternoon, Jeff. Good summary on what happened. Clearly, that was you could use the term black swan event. It was out of the blue. You're reading now that there was some known issues with SVB's balance sheet towards late 21, even at the earliest. But again, hindsight, everything's always much clearer, it seems, but kind of was out of the blue. Market reacted, violently down on that Thursday, at least on SVB stock. Remember, it opened down, I think 50% on Thursday, never opened on Friday. I might be wrong there, but it maybe declined another 50% on Friday. I can pull it up as I'm talking. But anyway, some of the Fed's actions, I would say, were lessons learned from the prior crisis, where they did react very quickly, both from a confidence standpoint for depositors, where at those banks, they said, we will exceed the limits of $250K for the FDIC insurance. So that, immediately relieved some of the depositors' stress. And then, that signal was not implicitly they weren't trying to implicitly say that they would guarantee all depositors at all banks, but that at least removed that fear that there could be other banks with other issues. As we know, there are some other banks with some balance sheet mismatches at the moment, given the rate rises that we saw in 2022. So again, I thought the Fed acted quickly, boldly, you could almost say, but some of it was from the 2008 crisis where, in hindsight, should they have let Lehman fail? Should they not have let Lehman fail? They forced the marriage of Bear Stearns during that time with JP Morgan earlier before Lehman, and then WAMU failed, and then JP Morgan took out the assets. So, they used the money setter banks, JP Morgan, Bank of America, the biggest banks in the US, they coordinated a little bit with them to make sure that, they're making the banking system stable, safe, and show that there's confidence in it. Now, that's my view as an equity investor, seeing those government actions, and then the reaction in the bond market was clearly the Treasury sold off. Now the thought is that there's a recession. Lending standards will be tightened. The growth of loans that provides GDP growth will, be retrenched a little bit given these tightened standards possibly. And you've taken out a few banks that funded, VCs and whatnot. So the equity market sold off as well. And then again, confidence shored up a couple of days later. There wasn't another shoe to drop. There was the UBS, merger with Credit Suisse, which, as you said, and rightfully so, was a troubled bank for many years post the financial crisis. But again, another global shoe to drop. So the market was kind of choppy for those first couple of weeks. It could have and maybe create opportunity in the regional financials. But from my bias and perspective, for the strategies at Essential and my prior firms, I'm typically underweight banks. There's an opaqueness to the bank financial statements that I just am uncomfortable with. Again, sometimes these, held to market, held to maturity securities, these available for sale securities, the tier one capital ratios you need to keep. It can, sometimes be opaque, and sometimes small changes in interest rates can impact those metrics significantly. So I've always tended to be underweight or even no weight in some of these regional financials. We do own JP Morgan, we own Berkshire, we own some, leading financials, but we don't have a lot of regional banks other than US Bancorp, which I think is a better position than some of the other ones. So to answer your question, I just wanted to give my background on the situation too that unfolded in March. There could be opportunities, but I'm just not comfortable enough to put our capital, Essential clients' capital, and some of the funds we're running into these banks at the moment, given, we are in a situation in the economy where there is signals and indicators of a slowdown and potentially more stress. Now doesn't seem like the time for us to want to do that. Again, if values get so compelling, way under book value, then we would do our homework again. But at the moment, I'm just cautious, Jeff, that I'm just not comfortable enough buying some of these banks.
Yeah. And like I said earlier, we're certainly in the early days of it. And that was a good point you made of the Fed acting very swiftly. Looking back to 2008, a lot of the programs and kind of everything, the way it evolved, it occurred over the course of a couple years almost. And many of the programs took, months to actually get up and running. So they seem to diagnose it pretty quickly, and banks should have, and certainly solvent banks should seem like they'll have reasonable access to liquidity should they need it. And I mean, we've had statistics now for a couple of weeks coming out from that, and there is some usage of the new facility. There's been some usage of the discount window. It seems pretty moderate to me based on really the overall size of the whole entire banking system. We're only talking about, I think, about 150 billion in usage when the banking system is an order of magnitude or more than that. So certainly something monitoring. And from the fixed income standpoint, we do have exposure to banks. It's mainly in the money center banks, and bank debt is a very large part of the fixed income market. So at times it's it's kind of a core holding that we do find value in, frankly. But again, something that we continue to watch quite closely as the situation evolves.
I mean, it's always tempting to, you look at First Republic trading at 140 before the crisis in March, and now it's trading at 13. So it's down, 80, 90%. And so, your first inclination is, oh, attractive, it's down a lot, which can be true. But, the market is sometimes smart enough to know that, hey, this is the next one on life support, and maybe it is a zero. So do you want to take that chance? Again, with some of the opaqueness of the financials and the mark to market and everything that encompasses how you come up with what your capital ratio is and what your equity is. So it's for us, it's just not worth the risk. Individuals might want to take a chance on some of these banks, but that's just not what we do for the portfolios that we run at Essential. We have to be very diligent in allocating our capital and taking a flyer on some of these down 80, 90% in a regional bank, which could appear to be a good value opportunity. But, living through 08, had plenty of banks that just went under, and stocks that just stayed permanently down. Citigroup is still probably, is it above its 08 levels? I don't think so. So some of these banks, permanently have a change in value when this type of situation, you put a lower multiple on the value of the franchise or the value of the entity when an outcome can be zero, for the sector. So the sector will trade, probably banks will trade at lower multiples going forward. And I think that's fair.
Yeah. And I think that raises a good point. It's all within the risk reward calculation that you and Pete and the team are doing, but also taking a step back that, there's probably, even though I would argue that maybe it's less of a regulatory problem and was more of maybe a supervision and enforcement of regulation type problem. And we'll see about that as the news flow continues. But a risk of higher regulation, or even just the FDIC is going to need to raise their deposit charges to help recoup their fund. That's going to weigh on bank earnings. Mm-hmm. Certainly possible slower economy, other types of, events there, banks starting to have to pay more on deposits. They've, for the most part, been paying very low rates. That sort of impact profitability too. So a lot of
headwinds in the sector, as you just, talked about. And so why would the multiples go higher at this point when, earnings are definitely have headwinds in front of them?
Yeah. So, certainly continuing to monitor, like you said, maybe at some point something gets displaced enough where it creates an opportunity, but it doesn't seem like we're quite there yet.
No, not comfortable yet. Not comfortable at all.
And, picking up on one thing you said, Randy, and kind of want to roll into our second topic on the economy and our refreshed update there, that one of the outcomes of this is likely a credit contraction or tightening credit conditions due to the bank stress. And, we had seen every quarter the Fed releases a survey of the banks and with regard to their lending standards. And we had started to see those already tighten prior to this episode. And one thing has to think that, now with these events, with the securities portfolios that happened, bank treasurers are going to be focused on those. They're also going to be focused on their deposits and liquidity and kind of defending the fort, so to speak. And so, if anything, lending standards are likely going to tighten. Credit conditions are likely going to tighten, and that'll gradually filter into the economy. Now, heading into this, the economy did look reasonably strong. The job market has remained pretty tight. It's been expanding rapidly. We got jolts today that, job openings came down some, but that's also along with a pretty rapid pace of hiring. We've seen the service economy has held up pretty well. Manufacturing has cooled down some. Housing seems to probably have bottomed, but there's also still a pretty large amount of pent-up savings that both consumers and corporations have. So, looking at this, again, it takes time to transmit through the economy, but with tighter credit being a headwind, inflation continues to be sticky. This tighter credit will essentially kind of add to what the Fed has been doing with their hikes and restricting policy. And we really still haven't felt the full impact of their actions, even from last year. So, consensus estimates were kind of coming into the year looking at recession possibly toward the later part of this year or early next. A month or two ago, things were looking a bit brighter with economic strength. But it now seems like with this banking stress, that's probably raised the probabilities. And again, no one knows for certain, so we look at probabilities, but probably raise the probabilities toward the end of this year, early next year. And, Randy, I was trying to frame that a little bit, but, you're looking at earnings, you're trying to project earnings. How are you seeing this impacting earnings coming up probably, second half of the year or next year as you're starting to look out?
Right. So good summary. Clearly there's more headwinds today than there were a month ago. There was some thoughts in February that the recession probably is late Q4, early Q1. Now maybe it's been pulled forward. But we've been doing this now a year plus on these calls talking about the recession that's coming at some point. Like, it's the most talked about recession probably in the history of the investment cycle of investing. So what we're trying to do is just, you need an anchor. You need to know what you're valuing your businesses on. It's not always just on next year's earnings or this year's earnings. It's earnings through a business cycle. So what we do in our intrinsic value approach at Essential is that we're trying to value the businesses we own through a business cycle, not FY1, not this year, not 23, not 24. So I do think you can get caught up in some of the headlines and some of the talk. The Fed's now it's cutting rates, now it's raising rates, the terminal rate is lower, the terminal rate's higher. That's all part of the market psychology and part of the market moves. But I think what I try to do is step back, and we have a base valuation, a base free cash flow estimate on our companies through a business cycle. Some of it's based on historical, some of it's based on experience, some of it's based on the company's view of their future cash flow generation potential. So what we're trying to do, Jeff, is just be balanced, not overreact 1 month to the next. We made some trades this, and again, we run 5 equity strategies here. So each strategy has a different mandate and a different risk parameters, or risk reward profile, risk return profile. So some of the funds we've traded more than the other funds. It all depends on the opportunities that we see in the respective asset classes or benchmarks that we're investing in. So value's traded a lot more this year than, say, core, because the value growth tilt we had in the portfolio, that has paid off a little bit. Growth stocks have done better than value stocks year to date. The quality and value names have kind of done similarly, and our core strategy tilts a little more towards quality, so we haven't traded as much. So the question of what are EPS going to do in 23 and 24, again, I think there's a bit of a rolling recession in certain sectors. The tech sector took a lot of the pain last year. Anything related, and I've said this, and I'll just say it again, anything in the semiconductor space related to PCs or smartphones got hit last year. Those are rebounding this year, or potentially those are rebounding this year, or at least you're not going to have the big drop. As you move into automotive, as you move into other industrials, they're hanging in there at the moment. Maybe there's slowdown into the second half of the year, but again, it's an unknown. But they're not coming off huge. Auto production is still well below 2018. Global auto production is usually in the 90s for units, so 90 million cars globally produced annually. That's kind of the numbers. I hit a peak in 2018 of 95 million. Again, that's EVs and combustible engine ICE cars. It's in the high 70s today. It was 75 last year. So again, it's not industrial and automotive. It's coming off a bottom still, almost, I would say. So again, these rolling COVID-induced impacts to different parts of the economy, it's not homogeneous. It's not like prior recessions where housing led, and then that led to that, led to that, led to that. This cycle, even on the housing, you said it was bottoming. I would tend to agree, but new construction was tailed off significantly into last year. It's only 10% of the overall home building market, new construction. But now I think it's probably, there's a shortage, there's a supply issue. So, some of the companies that reported, Pulte Homes reported and Lennar reported recently, they're thinking that second half is actually up now because a lot of the construction costs have come down, believe it or not. Lumber has come down, the material costs have come down. Affordability is still an issue, obviously, with interest rates going up, that the pace that they've gone up over the last 24 months. So long answer, as always. It's not simple to just sit here and say, this will lead to that, will lead to that. That's why we're balanced. We have a little bit more cash than normal. We're a little bit more defensively positioned because there is more uncertainty and more unknown today. But again, that does create the opportunity. So we got to be ready to be nimble and be tactical. So I don't think I answered whatever your question was, but I was just trying to frame what I'm looking at, what the team looks at, and how we're then trying to take that data, make decisions on the portfolios, and come to the bets that we have.
Well, I think one of the important points you made is it's in the balance of risks, and kind of given where we see the balance of risks has been leaning a little more defensively in the strategies.
Yes.
And I guess, for lack of a better term, kind of taking what the market gives us and, getting a run up in a particular name or sector, using that as an opportunity to, monetize some of that and adjust the portfolios accordingly for something with a little bit better risk reward skew.
Yeah. And Q1, the best sectors were tech, comm, and consumer. Guess what were the worst sectors in 2022? Tech, comm, and consumer. So, you didn't get a full reversal of the 2022 drawdown, but, you had a significant rebound in those sectors and those stocks. Everyone knows Meta, Netflix, Google, Amazon even have come off their lows of September pretty a lot. Meta's probably almost doubled or more than doubled. So some of these stocks were mispriced in the fall. We didn't add to all of them. We added to Amazon. Sometimes just holding is a decision, of confidence in the business, and you're just going to wait it out. Because again, peak uncertainty, sometimes, not reacting is the best move in hindsight. Sometimes, you wish you had added at that point in time, but, we didn't de-risk or sell some of the names that rebounded strongly in Q1. Now we're reevaluating them, make sure that there's still a risk reward skew there that we're favorable with. Like, as you said, try to find the opportunities where you can in the market chop that we've been living in for now 18 months.
Yeah. And really quickly, I thought I'd touch on the fixed income side. We've had a little bit of a similar theme. Moves a little bit more slowly typically in fixed income, but we've been increasing government exposures somewhat. It's been mainly through treasuries, and also in corporates. Incrementally been adding to some less cyclically sensitive and higher quality types of issues and sectors. Just again, with balancing the risk reward skew, those moves have made sense to us, and also adding a little bit of duration in portfolios, kind of in the longer end of the ladder, with when rates have been at higher yield levels. So
I'll ask you a question, Jeff, if you don't mind. I know we're at the top of the half hour though.
Sure.
Looking at my Bloomberg today, I see the 10-year at 330. The 10-year is my proxy for longer term GDP growth. It does get incorporated into the discount rate or the hurdle rate I use for my discounting of the future cash flows. So it's significantly off its October highs for sure last fall, when it hit over 4.25, it looks like. And it's really sold off since, the banking crisis in early March. Is this now saying that, the hiking cycle is done? I know the market prices in cuts into the second half. That appears what it's saying. I'm just curious your view and take. Can that happen if inflation continues to come in hot? Now, we'll see over the next couple of readings. And again, there is lags in a lot of that data, and the tightening of the banking sector that's just happened, that wouldn't show up necessarily in the inflation readings probably till the fall. So just curious your view here. Yeah.
I'm going to kind of break the yield curve into two parts. The front end and then the longer end. 10 years certainly isn't the longest maturity, but it's the a good proxy. And the front end is tied much more closely, and let's say for the front end, let's say 2-year type yields, is tied much more closely to Fed policy and anticipations of that. And interestingly, the 2-year, right before we hit this bank stress with Silicon Valley, it nudged right above 5%. And actually, we had just had a strong jobs report, a stickier inflation reading, and the thought was that the Fed is probably going to have to hike a couple more times than what they had projected in December.
Right.
And Fed rate was seeing maybe getting up to closer to 5 3/4, let's say, maybe even 6 was being talked about. And then the bank issues hit, and the 2-year fell well over 1% in like 7 trading days. And right now it's, it was in upper threes. I think it was around 385 or so.
Yeah.
A little earlier. So that is certainly, following very much more closely Fed policy. And, it's saying at this point in time, it looks like the Fed's going to be cutting some in the next year to two. I think that, well, and then, so let's look at the longer end of the yield curve. And that's more of a proxy for not only US growth and long-term inflation expectations, but also global. And global weighs quite a bit into it as well, with lower yields across much of the globe. So I think that, right now you have the banking stress, you have the flight to quality type trade, even just people kind of go into cash, that kind of thing, even though equities are higher, but you saw that initially, and investors, traders kind of maybe taking out a little bit of insurance, if you will. And I think back to your question with inflation and it being stickier, that's going to be the real challenge. Is, does it stay stickier? I think some of this will take time to work through. I think the Fed's going to be kind of fighting the market on that some. And does this liquidity facility, this BTFP, we got acronyms again, does that take care of it for banks that are feeling stress? If it really does, then the Fed has kind of, quote, sectioned that off, isolated it, and it can try to rebuild its credibility, bring inflation down. And, I think from the Fed standpoint, they would rather maybe hold their funds rate at terminal longer and maybe have a hike or two less than hike, more maybe than anticipated, and then have to cut more quickly. Right. Because I think they want to really send the market, they want to bring inflation down. They want to send the message that, they're serious about it, and that, they're going to bring it under control. They don't want to be, Powell doesn't want to be Arthur Burns, and have more challenges down the road. So I think all that said, we're going to see more volatility, especially in the shorter maturities, and the longer maturities are pricing in, hey, the recession odds are increasing, and we're probably going to see those, maybe those have downshifted, whereas at late February, early March, we got above 4%, right at 4%, a little above 4% in the 10-year. It's probably more of a challenge to get back up to those types of yield levels, and we're probably more, mid type 3% and possibly lower 3% type area.
So it's data dependent, as they unfortunately have been stuck in this cycle of waiting for each month's reading to help them, determine what the right terminal rate should be, because we don't, again, there are lags in a lot of the data, and it's hard to anticipate what it will be. So that's my view as the equity investor, that whatever is thought today could change in the next month or two. So try to be, again, that's why the portfolios have, a little bit of more of a defensive tilt, a quality tilt, just to be aware that things can change rapidly, and we'd rather have that cash to be able to tactically put the work than to actually just sit there and see opportunities come but not have the cash readily available. So that's the thinking. That's how we're running the portfolios this year.
Yeah, I think it's important to be, we're in an environment where being able to adapt and adjust is certainly one of the, I think it'll be important in the strategies, because things can change quickly. They may not, maybe early March was the issue, more isolated type, banks where this was occurring, and then it comes back to more of a focus on the economy and inflation and how that evolves.
Right.
But it's, being aware that there could be other shoes.
Right. We're all geniuses in hindsight, Jeff.
That's right. We did get one question in that I wanted to address, and it was regarding de-dollarization, and really kind of, question about.
Did you say bee pollinization?
Unfortunately not.
Oh.
No, de-dollarization.
Oh, okay, sorry.
Yeah, my enunciation's not always great. But really, kind of the crux of this question comes down to the US dollar, and it will be able to maintain its reserve currency status. And, kind of looking at this, taking a step back, that the US and the US dollar has a lot of advantages in its favor of being a reserve currency, of why it is the reserve currency. And, it's a generally stable currency. All currencies fluctuate now, but you have more stability, certainly liquidity of it, and along with that, the size of U.S. markets and the economy is a big component. It can handle capital flows, and we see that in times of panic, whether it be 2020 or more recently, it can handle that. Another factor is the strength of the U.S. military, but also maybe almost as importantly, or even more importantly in some respects, is the U.S. law and property rights of asset owners, and that is something that it attracts capital and helps the dollar be the reserve currency. So, we're having this discussion this morning. There's no doubt that with deficits and spending that our country has been engaging in, one can argue that it's not been the best steward of its currency. But on the other hand, it's also hard to argue that other major developed market economies have been much better. The euro, the yen, the pound sterling, et cetera. One argument you hear is China and the yuan. China also has very high debt loads, and there, frankly, you can only get your assets back when their government says that you can. That comes back to the property rights and free flows of capital in and out that the U.S. does have. So, kind of looking at this, the U.S. tends to be the cleanest dirty shirt, and it's not an issue to ignore, is my take, but really to kind of unseat the dollar, I think it takes big changes in the global economy over decades or probably generations to make it, for the possibility to unseat the dollar as the global reserve currency. So, certainly always something being monitored, being aware of, but there is, in the midst of everything we've been seeing for the last several years, there are, taking a step back, there are a lot of positive advantages that the dollar does have when evaluating it versus other currencies, as it's a relative gain.
Right. I agree with that. I hear about this every once in a while. China, Brazil, one of these blocks are going to form, and That'll be the new trading currency. Give me a break, whatever, sure. I just put zero into that because of the issues you mentioned, one from a governance standpoint, just from, capital flows, from stability of the government. I mean, in Europe, you have the Euros, a block of, all those countries that have different regional issues. So it is non-event, in my opinion.
And, some of this talk tends to come from the countries or surrounding those countries that have had sanctions put on them. They would love to have an alternative to the dollar, so that the bad actors don't get their cash and assets tied up when we do impose sanctions. But
right. Yeah.
That's another kind of side of it. But anyway,
next month's call will be about bee pollinization. How's that? We can end it just leaning towards that for next month.
I'll try not to get stung doing that research. Well, on that note, we'll go ahead and conclude today's call, and we hope you'll join us next month on Tuesday, May 2nd at 12 o'clock Eastern. We thank everyone for joining us today, and we hope you have a great rest of your week.